Well, welcome back, everybody. Victor Adair sitting in here for Michael Campbell this morning. And it is indeed my pleasure to tell you that our next guest here is Dennis Gartman. Dennis and I have been friends for donkey's years. He's been writing his daily letter about the markets for over 30 years. His letter is read all around the world. Tens of thousands, believe me, professional traders read his letter every day. He comments on the currency markets, commodity markets, crude oil, certainly, grain markets, stock markets, and then takes an interpretation of the political landscape. He is regularly on CNBC and other of the financial news channels. He speaks at a lot of financial conferences. Dennis and I have even played golf a couple of times. We've had lots of dinners at different places around the world. And one of the things that I like about his letter, and I'm sure a lot of those professional traders like, is that Dennis gives specific trades that he's doing in his own account when he talks about the market. So, Dennis, welcome. It's so great to have you back on Money Talks.
Great to be here. They're obviously scraping the bottom of the barrel in both instances. Mike scraped the bottom of the barrel, put you on, and you scraped the bottom of the barrel and put me on. Let's hope we can come up with something interesting, funny, and useful.
Well, that's a great start. You are the liberal arts major that tries to explain to the currency trader what's going on in the crude oil market and vice versa. How do you frame that again?
Yeah, I've always said when I started writing this back in 1987 on a full-time basis, I thought that I would be the liberal arts major, the capital markets, the fellow who could talk to the foreign exchange trader about what's happening over in the crude oil market. I can't tell a crude oil trader more about crude oil than he knows or she knows, and if I can, he or she won't be trading crude oil very long. But perhaps I can keep the crude oil trader from being blown out of the water by something that's happening over in the foreign exchange market. I can't tell the foreign exchange trader more about that market than he or she knows, but perhaps I can protect them from something that's happening over in the political environs. My job, as I see it, is to look down on what's going on from 35,000 feet, have an understanding after almost 40 years of being in the markets about what moves the psychology, what moves the fundamentals, and write it down in an early morning. I get up at 1 a.m. Eastern time so I can have this thing out to everybody by 5 o'clock in the morning, and with a bit of humor, hopefully, every day, and a cogent analysis to keep people informed on what's really going on. So that's my job, and I've been very fortunate. Very few people in life get to say that they love to do what they do. I love to do what I do.
Well, not only humor, but humility. I know I see a lot of letters that are written by people that are offering their views and their opinions about markets, and a lot of them seem to have selective amnesia when they're wrong. You own up to it right away, and that's that part of trading. You got to be prepared and willing to take your losses as you go along.
And absolutely, it's probably more important than being able to take winners is to be able to say I'm wrong, and to hopefully learn something from it. It is amazing how interesting the markets can be, how often you can be wrong, and the objective here is to be wrong, not fewer times, but to be wrong on smaller occasions, and to admit it as rapidly as one can. That's I think the important thing here.
Dennis, you start your letter almost always with comments on the currency markets. Of course, our folks here in Canada are particularly interested in what you think about the Canadian dollar. Let's start with the currency markets. What's your perspective? What do you see from 35,000 feet?
Well, I think, first of all, talking about the dollar versus the euro, we'll speak about that first. I think the euro is going to get demonstrably weaker. It has been weakening up now for quite some long period of time. And I suspect that trend toward a weaker foreign exchange market, toward a weaker euro, is going to continue going forward. I actually believe that by the time this is done, we'll trade the euro down towards par, if not below there. It was, about 2 years ago that we were actually trading the euro above 140 euro to the dollar. Now here we are at 112, and I think we're heading on our way towards par because the political circumstances in Europe are really as fractious as I have ever seen them. We have separatist movements starting in a number of countries. We have far right versus the far left in a manner I haven't seen in quite a long period of time. And the basic country of Europe, Germany, is having as many political problems as we have ever seen it having in the past decade or two. So I think that on balance, the U.S. dollar, and I think by extension, dollars generally, and when I speak about dollars generally, I usually wrap the U.S., the Canadian, the Aussie, and the Kiwi into one kind of nice little package. I think on balance, dollars will do demonstrably better than shall the euro over the course of the next 6 months, 1 year, even going forward to 2 years. I think the dollars will get stronger. Concerning the Canadian dollar, the violence of the past month and a half has really quite surprised me. We've seen the Canada versus the U.S. moving 100 pips down, 100 pips up, 100 pips down, 100 pips back up, and doing it in violent swings. It makes very little sense to me. I do tend to look at the Canadian dollar. I look at it in terms of Canada versus the U.S., and we have seen the Canadian versus the U.S. trade above 140. Canada to the U.S. dollar. I think that's actually going to make its way back closer to 120 over the course of the next several years. So if I'm going to take a position on Canada versus the U.S. dollar, I'll probably err on the side of being bullish of Canada, bearish of the U.S. dollar on balance. That doesn't mean I shall always be that way, but probably on balance, that's the way I shall lean.
Yeah, and when you are taking your trading positions, I mean, it's going to change from time to time, but what do you think is your time horizon typically when you take a trade? I mean, is it it's not 2 hours, but maybe it's a couple of days, a couple of weeks, a couple of months, years? What do you think?
A couple of days, couple of weeks, and hopefully something that might last for several years. For example, when I'm bullish of gold, but not in U.S. dollar terms, because I think the dollar is going to get stronger. So I'm bullish of gold in the currency that I think shall be the weakest, which is going to be the euro. I want to own gold, and I want to pay for it with euros because I think the euros will devalue. I've actually had that trade on now for 4 years. It started off as a short-term trade, but it continued to work. It held firmly. I think it has fundamental merit to it. So on balance, I would say that my perspective would be for the next 2 weeks, but if something continues to work, why not continue holding it? And in the case of gold in euro terms, it's been working.
So bottom line then, on the currency markets, you are U.S. dollar bullish and the other dollars bullish, but the one that you really got in the crosshairs is you think the euro is going down.
To par. To par versus the U.S. dollar, if not lower. Now, what may interestingly happen, I mean, you're starting to see the European economy itself demonstrably weaker than is the U.S. economy, demonstrably weaker than is the economy in North America, and the political environments being far more confusing. And as I like to say, confusion always breeds contempt for whatever instrument you're trading. I do think that we're going to trade to par, and I wouldn't be surprised if we trade under par. Now, the question shall be, if you have another exit of one of the major countries, and you have to start thinking that Spain could do so, that Portugal might do so, that Italy might do so, now that England has voted to do so. If that happens, during that period of confusion, the euro will get demonstrably weaker. But there shall come a time when, and it may be 4 or 5 years from now, that's a long way into the future, when you have a rump euro comprised of the northern countries, that could get demonstrably stronger. But that's a long way into the future.
We'll take a break, Dennis. I need to go to take a commercial break here. But when we come back, we'll talk about crude oil. We'll talk about the stock market. And if we have time, we'll talk about the political landscape and, of course, the election looming in the United States, what that impact that may have on the markets. We'll take a break here. We'll be back in about 3 minutes. You're listening to Money Talks all across the Chorus Radio Network. Well, welcome back, everybody. We've got Dennis Gartman on the line. We're talking about the euro in particular in the currency section there. Dennis sees the euro fraught with all kinds of problems and headed toward par. The euro right now is around $1.12, $1.13, that sort of thing. So possibly a good move down in the euro. And with respect to gold, Dennis likes gold, but he likes gold not so much against the U.S. dollar, but he likes gold in terms of the euro. Very interesting perspective, and you can certainly trade it that way. Dennis, we're going to go through things here because we're always running out of time. Crude oil. I know you always have a special section in your letter on crude oil. The supply-demand story. I mean, we've had a huge move in crude oil over the past couple of years. Again, from 35,000 feet. What do you see in the crude oil market?
The trend, I think, is still clearly downward. And one of the things that I watch is the contango, the carrying charge. I've learned over the course of the past two decades that as goes the contango, so goes crude oil. If the front months are losing relative to the back months on up days and on down days, if crude is bidding for storage, as I like to say, that's telling you the story of an abundance of supply. And I think we have an abundance of supply. Clearly, we're seeing the 1 year contango now is out to $5, and at $5, if you've got spot WTI, let's call it at $43 a barrel. If 1 year forward is at $48 a barrel, hedgers are going to be very amenable to producing crude oil in the better production areas of the Permian, the Bakken, the Eagle Ford. They're going to produce crude oil and sell that deferred future because the bankers are going to ask them to do it, and do it with alacrity. They'll be aggressive in doing so. Fracking has changed the world. There's not a question about that. We continue to find frackable lands here in the United States. Apache just announced a huge new find in southwest Texas that they think might have as many as 2 billion recoverable crude oil barrels. And as in speeches that I have given over the past several years, I've often euphemistically said, concerning fracking, unless you think that God was so segregationist, and I use that term euphemistically, and only allowed the United States to have frackable land, you're naive. There is frackable land to be found everywhere around the world. Argentina just announced a huge new find of frackable, capable oil that they may have 2 to 3 billion barrels of crude. If Argentina has frackable land, Canada has frackable land. Saudi Arabia has frackable land. Australia will prove to have frackable land. Russia will prove to have frackable land. And they will all be the beneficiaries of the economies of scale that American frackers have learned on their own, driving the cost of production. Let's say 4 years ago, good fracking land probably required $70 to $75 per barrel to make it profitable. Now you can produce crude oil at $18 to $20, and that will be even lower next year. So the world, I think, is going to be abundantly supplied with crude over the course of the next 20 years, all because of better technologies. That can't be anything other than bearish. And I think the Saudis understand that not only is more crude going to be found and found more amenably, but the ability to drive the usage of crude oil steadily downward. As I like to say, my first car in 1967 was a 1965 Plymouth Valiant that got 7 miles to the gallon. New cars nowadays get 30, 35, 40 miles to the gallon, and 5 years from now they'll be getting 50 miles per gallon. So we are finding more crude. We are using it more efficiently. That can't be anything other than bearish for the crude oil market. I know that Canada, especially Alberta, will not like to hear that, but I think that's the harsh reality.
Dennis, we're going to move right along before we run out of time, and I appreciate those extensive views there on crude. It's certainly a supply-side story from where you see it. The stock market had kind of a quiet, listless summer, and then as we got into September, we started chopping around. It seems there's folks that say the stock market's richly priced. Other people are saying, Tina, there is no alternative. What do you think?
I think there is an alternative, and I think the alternative is cash. I think that stock prices are extremely high, extremely overpriced. I think the propensity on the part of economic activity to increase and at the same time put downward pressure upon stock prices because money will move from the capital markets into plant and equipment and employment. I think that alone is going to be detrimental to share prices. The economy can do better. Stock prices may do, I think, a good deal worse. So I'm not a believer in Tina. I'm a believer in Cena. Cash is the other alternative. I think that's probably the great place to be right now, is on the sidelines. Oh, I know you have to have some exposure to the equity market. I understand that completely. You can't be fully out. But I think if you were fully invested 3 months ago, probably it'd be a better idea to be half invested going forward for the next several months.
And Dennis, while we have time, I mean, we've got to address the political view of things. I know you've always had a big section in your letter where you're doing a political analysis because it's just so important to the capital markets. We could start with Trump and Hillary. I mean, what do you think about that?
I don't like either of them. I probably will end up voting for Mr. Trump only because I cannot vote for a leftist. But I am embarrassed by the fact that these are the best two candidates that the United States of America can put forth as our leader, I'm stunned by that fact. I suspect that she's probably going to win the election, but I must admit, in the last week and a half, her momentum has turned demonstrably against her. Momentum has turned much more in favor of Mr. Trump. I'm surprised by that fact. She didn't do herself any favors with the stumble this past week at the 9/11 memorial. That certainly is going to hurt. And he seems to be handling himself a little bit better in the and looking a bit more presidential. He had a speech in front of the New York Economics Club on Thursday. I watched that, and he actually was really quite impressive. In fact, more impressive than I've seen him in the past several weeks. So I thought a month ago that she would win 45 out of 50 states. I think she still wins the election. I will be terribly dismayed by that fact. But instead of her winning 45 states, maybe she only wins 35.
And in terms of the Electoral College, the market seems to have assumed that Hillary is going to win. So you and I both know if the market gets surprised, you usually get the dramatic price action. If it turned out that Trump won, looking across the markets as you do, is there any one thing or two things that you think might happen? We've got about 30 seconds here for an answer.
Historically, Republicans are very bad for stock prices. They're very good for the economy, but historically, Republicans are very bad for stock prices. I think the market would be terribly surprised if he were to win. I think that would be terribly detrimental, at least for the first 6 months, maybe a year of his administration. Perhaps after that, you would turn it the other direction. But historically, not a good thing when Republicans, and I am a Republican, I'm of the right, but the market tends to not do very well during Republican administrations, tends to do very well during Democratic administrations. Why? Because they tend to be expansionary in their policies.
Dennis Gartman, my dear friend, I wish you good health and good trading, and I look forward to seeing you the next time we get a chance to get together.
Let's play some golf and let's have a martini.
Dennis Gartman, everybody. Thank you very much, Dennis. We'll talk to you soon.
Cheers.
Well, I guess I said goodbye to Dennis just a little faster than I really had to, but we've just got 2 minutes here. Let me give you a quick review. Looking at the euro currency, he sees it being a lot weaker against the U.S. dollar, but also weaker against the other dollars, as he calls them, the Canadian, the Australian, the New Zealand. The Canada, he's been surprised at the violence in our move. Basically, his view is over the next couple of years, he says, he thinks the Canadian dollar may do better against the U.S. dollar. His favorite trade, and I know he's had this trade on for 4 years or so now, he's been long of gold in terms of the euro. Most of us think of gold in terms of the U.S. dollar. He's got that trade on where he thinks the euro is going to weaken, but the way he chooses to play that instead of being short the euro and long the U.S. dollar, he's long gold and short the euro. He had some very interesting comments there on crude, some very extensive comments on crude, but basically the message was he thinks the price trend is down. Fracking has changed the producers can now make money at much lower prices. He's even suggesting in some areas maybe as low as $20 a barrel. That seems an astonishing number. And then I love this line, the world will be abundantly supplied with crude oil. As there's a lot of crude coming on, there'll be frackable land in other places of the world besides the United States. And of course, we're always using the energy more efficiently. Stock market, I guess two things there. Tying that in, he thinks that stocks are richly priced. Cash is not a bad alternative. And then on politics, the market, of course, is priced for Hillary to win. If that doesn't happen and Trump wins, he says Republicans are always bad news for the market. I should say always, almost always bad news for the market. He would see a Trump win, meaning the stock market might take a hit. We are going to take a break here at the bottom of the hour. I need to tell you that Money Talks is brought to you by Solera Club, a royalty no-fee investment. And for more information about that, you can go to soleraclub.com. And we will, I guess at the what are we going to do? We're going to come back and, yes, we're going to go straight to Ozzie Jurek. That's right, after the news, because real estate, so important here. You're listening to Money Talks all across the Chorus Radio Network. Well, welcome back, everybody. Victor Adair sitting in for Michael Campbell here on Money Talks. And let me tell you, you want to take a look at moneytalks.net. Mike and his team keep improving this website. There are a number of very current stories or opinion pieces, that sort of thing, articles on the markets there. And, of course, you can also follow Mike on Facebook and Twitter. So take a look at moneytalks.net. It's just really a lot of stuff on there and getting better and better all the time. Ozzy, are you there?
Yes, I am. Hi, Victor.
Do I hear Ozzy?
Yes,
hey, Ozzy.
I'm here.
Good. Well, I wasn't absolutely sure. Glad you're here. Listen, it's the key topic, of course, is going to be on taxes and that sort of thing. I knew you attended a lunch yesterday above a lot of real estate professionals. We want to talk about that. But right off the top here, I want to tell our folks that are listening that you are having your 24th annual Real Estate Outlook Conference. I didn't know you were that old. And that's, what's that, next week?
Well, that's what my son said. My God, you're getting old. It's 24 years of forecasting real estate markets. Well, but a nice, spectacular track record, too. We have an all-day seminar at the Marriott Hotel downtown. We have two speakers talking about the U.S., one from Phoenix, one just about finance in the U.S., which is getting a lot easier. We also have somebody talk about New Mexico. And then we talk about 6 speakers, of course, talking Canada, and we're looking at the best financing available. You know, Victor, it's really become very difficult to get your investment property financed, and I think that's going to get even tighter. So you really need some expert advice. And I certainly look at my annual forecast, all the different areas we forecast, the best areas in Canada, the best in the United States, and we'll have some surprises for the attendants. We got a real specialist for Vancouver Island. We have a great developer for the Fraser Valley. So where the deals are, the best suburbs, the best small towns, and of course my 9 astounding predictions.
If you do say so yourself.
Yes.
Ozzy, the conference is next weekend, and they can get information about it at jurock.com. I'm assuming the conference is in Vancouver somewhere.
Yes, it's on the Marriott Hotel on Hastings, right downtown. People can go to reoutlook.ca. That's RE, like for real estate, reoutlook.ca, or go to jurock.com, jurock.com, or 683-1111 and leave a message. We'll get back to you. Tickets are only $2 for $97 this weekend, so I urge you all to attend. It's going to be a smashing conference.
Okay, Ozzy, thanks for that. Now, there's 2 main things I'd like to get to. One is, I know you told me you were going to a luncheon yesterday in Vancouver where you had a very, like real estate professionals there talking about particularly the tax and the impact of the tax. And I'd like to go to something I saw in one of your facts by mail here just this week. 4 reasons why BC real estate is not in a bubble. I think you make the point that, you know, there's a lot of maybe a lot the worries or the concerns here are a bit overblown. You know, keep things in perspective. But first, what did you learn yesterday at the luncheon that you were at with respect to the taxes?
This was the fall luncheon for the Urban Development Institute, and 750 people attended. I think it was their best attended ever. Neil Crystal, the president of Polygon, spearheaded the panel discussion between Tom Davidot and Sir Summerfield UBC, Helmut Pastrick, long-term chief economist of Central Credit Union, and lawyer Arnold Darkner of Dentons. And they had a fairly spirited conversation, Victor. The retroactivity of the tax was called by several both morally and ethically wrong. Well, Michael and I have talked about that before. They talked about the Premier saying in May that she had no intention of interfering in the market, and then this bombshell, you know. So the point here is that Helmut Pastrick felt the 15% tax was simply too high, and all these new taxes really didn't benefit us in the long term. He particularly disliked the policy shock to the system, but he was fairly positive. After 3 to 7 months period of slow sales, he thought we would stabilize. We then would get back into a normal cycle, but we're also at the end of that cycle. So if we were going to a recession, there might be a downturn in the real estate market that would be substantial. So a very interesting time we had there.
So, Ozzy, I know you and Mike have talked about this many times, but what's kind of the update? What's been happening most recently in the Greater Vancouver real estate market in terms of listings, sales, prices, that sort of thing?
Yeah, well, what the point that we made was that we like in our newsletter to talk about the average price, and I know that the benchmark price that the boards do is good for a longer period of time. It evens things out. But I like to know what's happening in the market now. So while, for instance, we constantly get information about how much better we've done this August versus last August as far as prices are concerned, if you measure yourself against this April, we've seen substantial declines in most areas already. So we were already in a downturn certainly for volume of sales of single-family homes, and at the same time in a downturn in condominiums as well, long before the tax came in. And then the tax came in and was a shock to the system. The big thing is that was also discussed yesterday is that the tax maybe have some other consequences you don't think about. We're a province that needs capital investment from foreigners in mining and LNG and agriculture and dozens and dozens of industries, and they might just take a second look and saying, why would I go there when they changed the rules on me several years ago? I might put in millions and millions of investment into, create all these jobs, and finally when payoff time comes, they'll say, oh, well, retroactively we just changed the ballpark. And investment will flow to other provinces.
Mm-hmm. Well, yeah, that's definitely a concern. It's hard to measure, of course, as how that'll happen. But you were saying that one of your panelists thought that we'll have, let's call it a little bit of a shock over this tax, but we'll get over it and then we'll get back into a normal real estate cycle. Well, something you were talking to me about a day or two ago, you were saying that we're measuring prices what they are now compared to what they were a year ago, and they're up. But actually, since April, again, Greater Vancouver average prices have been trending down. If I got that clear?
Yeah, absolutely. And, when we go by suburb to suburb, some of them have seen substantial price declines. In West Van, the average price was a crazy $3.8 million in April, and it was $2.9 million in August. Now, these are big number suburbs, and you might just want to throw them out. But if you go to Vancouver East was $1.8 million in April, and now was $1.45 million. So we've seen declines between 3 and 8% since April. Yet when you look at the published stats, August over August, we look so far ahead. And so there has been a shift in the market sentiment. And right now, what realtors are telling me is that the buyer just is holding off. I am just going to wait. I just am not sure. It's Dennis and you talked about uncertainty in the market, and that's what we have now. We're seeing price declines already where the buyer goes in North Van and buys a house, but he makes a much lower offer, saying to the owner, look, we want to buy, we want to move our family here, but we don't know what's going to happen. I'm not going to pay the full price, and some owners are accepting the lower prices.
You're right. Certainly psychology changes in markets. At one point in time, everybody's a buyer, and they're falling all over each other to do so, and then there's a change and so on. But let's go to this other focus. I thought this was just a great article you had in your recent weekly letter, 4 reasons why BC real estate is not in a bubble. This is like kind of keep a perspective on things, folks. Yeah, prices have come off their top, but we're not falling to zero by tomorrow.
No. In fact, we've had several times before where the end of the world was forecast. I mean, the latest was 2009, when within an 8-month period we turned the market around and then started a great boom. I mean, it looks like a bubble, and we're fearful, but I'm saying to my subscribers, repeat after me. We're not in a bubble. I mean, a bubble is when a buyer's market comes, and that comes when the sales-to-ratio listing falls below 12%. So in that scenario, we really only have the Kootenays and Northeast BC that has a ratio lower. Vancouver and the Fraser Valley, the ratio is around 30%. It's dropped to something lower in some of the higher-priced areas of the city, but then you go across the island, you were talking about it earlier, in Victoria, the ratio is still over 25%, and it trends even higher because of the lack of inventory. So first of all, look, we have our money market. Money is almost free. In our mortgage at 2.5% or lower, we've seen 3-year money at 1.99%. So number one, that is still whatever you buy, and particularly if you buy something that your tenant pays off, half of that payment goes into your jeans. I mean, on a $300,000 mortgage, you pay $1,400 a month. $700 of that goes into your pocket. So even if there was no price increases, you would do quite well. Secondly, we got huge job creation. I mean, the city of Vancouver has been growing by 6%. I mean, it's amazing. And so we have the same growth level as we had in sort of mid-2005. We have the lowest unemployment rate in Canada. So we have strong population growth. Interprovincial migration is huge. We've been the 12 months ending April 1, almost 19,200 people from other provinces and 40,000 immigrants. So all of these people need a place to rent and a nice place to buy. And then finally, there's still a shortage of homes for sale. I think in 2009, when the market changed after the economic collapse, there was a huge inventory of unsold properties. That is not the case today. Try and move into a condo right now, into a new condo, You can buy a pre-sale, but that means down the road you can move in. Very difficult to find something new that's ready for you to move in.
So there you have it, 4 reasons why the BC real estate market is not in a bubble right now. Ozzie, we've got just moments left here. Do you have one hot property for us?
We got a great one in Phoenix, fourplex, $299,000. It's in a great area. It's completely refreshed, updated plumbing, electrical. It's always rented out, and it has a 7.5% cap rate. We think it's a great deal.
Ozzie, best of wishes for a great conference, your 24th annual Real Estate Outlook Conference coming up next weekend in Vancouver. Thanks for being on the show, and we'll talk to you again soon.
Thanks, Victor. I'm enjoying you.
Folks, we're going to take a commercial break, and we're going to come back, and we're going to have me and my son, Drew Zimmerman, talk about the trading desk, what we're doing in the market and why. You're listening to Money Talks all across the Chorus Radio Network. Well, here we go. We are going to do the trading desk segment. We're going to do it as a back and forth. Drew, are you there on the line?
I am, Victor. Thanks for having me on.
Okay, excellent. You gave me a little scare there for a minute. Folks, let me tell you, here's something that Drew and I do every day. I'm on Vancouver Island. He's in my office downtown. We probably spend 15 minutes, 20 minutes kind of reviewing what we're doing in the market, what we see happening, what we're preparing for, how we're trying to manage our risk, that sort of thing. And to just get right to it, I'll tell you that basically our position is this. We're bullish of the U.S. dollar. We're bearish of commodities. So generally speaking, then, we are long of the U.S. dollar index. We are short of the Canadian dollar, short of the Australian dollar, short of gold, short of WTI, short of the U.S. stock market, and short of U.S. Treasuries. I guess, Drew, we've got a little bit of a bearish attitude on some things, but really, let's go to the Canadian dollar to start with. What do you see there? What are the important things about the Canadian dollar?
It definitely does sound like we have a bearish tilt across the board, but that's the environment that we're in right now. We've talked about the market fragility that we've seen over the summer. The Canadian dollar especially has been 5 months of going sideways in what I would call a 2 to 3 cent range. We're now at the bottom of that range. We're at a 6-month weekly low close on the Canadian dollar. We've had the Bank of Canada come out with a very dovish stance. The lower for longer is here in Canada, even more so than in the U.S. And I think that is the key right there, is that the U.S. dollar could be going the other way, and Canada will be staying very dovish on their central bank policy.
Yeah, as we often say on the show here, it's not just about the Canadian dollar, it's about the U.S. dollar, and Canada just kind of gets hit with the backwash in a way. Here's something else on the currency side. This is one of those things, here's something you didn't know about. Drew, tell them about the Mexican peso.
That's right. It's not just the northern border that our currency is going down on, but the southern border. The Mexican peso is now traded to its all-time low against the U.S. dollar. Back in July of 2014, when oil was still at $100, you could get a U.S. dollar for 13 pesos. It now takes over 19 and a half pesos to buy one U.S. dollar. Just to bring that back home for us, that would be under 67 cents Canadian if we had that same sort of drop.
Yeah, another thing, by the way, on the Canadian dollar is that we pay attention to market sentiment and one of the technical ways of looking at who's got what on in the market. And we see that the speculators in the market, this is call it a catchphrase for hedge funds and that sort of thing, still have a very substantial long position in the Canadian dollar. If Drew was just pointing out, we've broken down here to 6-month lows in the Canadian dollar. If we start to go a little bit lower, we're suspecting that some of those speculators may have to throw in the towel, and that would add selling pressure to the downside. Drew, you probably heard what Dennis Gartman had to say about the euro. He really doesn't like that. Let's move on to the oil market, where we've generally been bullish, I should say bullish, bearish on oil. We heard Dennis Gartman's view there on the supply-demand. Anything to add to what Dennis had to say about oil?
I think he had a great overview. The continued oversupply story just continues to find a new chapter. Every time that we're supposed to run out of supply, we find more. Every time we're going to lose production out of OPEC, they raise production out of one of their countries. So the fact that we are now at new 5-week lows in the oil market under $43, the lows of August at 39 are definitely within a testing range. And we've also been adding oil rigs in the U.S. for 12 straight weeks now.
If we look at the gold market, I know folks have heard me talk about being on the short side of gold. The recent positions established there when the gold market peaked just after the Brexit vote, that we had one huge move up. I think it was up $100 one day in gold. But there's a backstory to gold, and that is that the thing that's probably the most important to the U.S. dollar price of gold, obviously the U.S. dollar, but it's what we call real interest rates. That is, when you take the yield on the bond and subtract out the inflation rate, you get the real rate. Interestingly enough, that when gold was making its highs in the middle of July, real interest rates were making a low. And we've seen recently here in the last couple of months, interest rates have been creeping higher in the United States, and real interest rates have been creeping higher as well. And one more thing on gold. There is the physical market where people buy a bar of gold and take it home, buy gold coins, take it home, whatever. And then there's the paper market, and that's the markets that I trade in, the futures markets, the ETFs, and that sort of thing. And it's my perspective that people buy something in the paper market because they're looking for the price to go up. They don't have the same passion about owning a gold bar that the physical buyer does. So if the people who bought, and there was a ton of buying in the paper market here earlier this year, if they see prices starting to go down, they may be a seller. I think the key level to watch on gold, Drew, about $1,300 or so.
That's exactly right. If it breaks that level, you see an uptrend that's been broken, a support level that's been broken. And more importantly, I think in the last few days, we've had 7 of the last 8 trading days in gold be down days. This has been days when the volatility in the S&P has really started to pick back up again. So when people build gold into their portfolio, they want something that's performing better when their stocks are going lower, and we're just not seeing that sort of bid come into gold. So to me, that means that we could see a little more weakness to come, and again, with all the other reasons that you had alluded to.
Drew, thanks for taking the time. That's a wrap for the Trading Desk. We'll take a quick commercial break and come back for a wrap-up. You're listening to Money Talks all across the Chorus Radio Network. Well, I obviously lost track of time here as the show progressed along. I have to say thank you to all of our guests, Rob Levy, Tom Whitfield, Dennis Gartman, Ozzie Jurek, and my son Drew Zimmerman. I thought we put together a good show for you this morning. I also need to remind you that Money Talks is brought to you by Solera Club, a royalty no-fee investment. And for more information about that, you can go to soleraclub.com. Also, you want to make sure you check out the new look at moneytalks.net. They're putting up more and more new stuff there all the time. And, of course, you can follow Mike Campbell on Facebook and on Twitter. It's been fun being with you this morning and hosting the show. Mike Campbell will be back next week, and I'll be just sitting here doing the Trading Desk. Go out and have yourself a great weekend. Thanks for listening. You've been listening to Money Talks all across the Chorus Radio Network.